The Bank of Japan signals an upward shift in interest rates, boosting the yen and spooking global equities. Stocks slip with metals and realty seeing sharp cuts, while healthcare and banks fare slightly better. Reliance Retail Ventures announces a plan to trim holding in Just Dial to meet minimum public shareholding norms, as do promoters of Sterling and Wilson. Meanwhile, promoters of Dabur likely sold shares via block deals. And Hinduja Global Solutions offers to buy back a chunk of the shares at a hefty premium, while IRB Infrastructure is set to consider a stock split, even as Ramco Systems eyes a fundraise. And the SEBI board is set to meet today and likely to review the buyback panel's recommendations for phasing out open market buybacks while boosting the size of tender offers. Hi guys, a very good afternoon and welcome to Business Lunch. I'm Pavitra Parekh. Those are all of the headlines that we are tracking for you at lunch hour. So there's lots to talk about, especially ever since, we got that action from the Bank of Japan. And ever since then, our markets have sort of just moved much lower. So for now, we're just slightly off the day's low, but it is still around an 0.8% cut that we are seeing on the frontline index. The mid-caps also completely in line today. So we're seeing around 250 points gone on the mid-cap index as well. The banks is where we're seeing slightly better action. But still down around 0.6% on the banks. So a few of those stocks. But by the way, take a look at the rest of the Asian markets if you want to feel slightly better. You have Hang Seng, you have Nikkei, all seeing cuts of over 1.5% right now. So that's definitely looking quite weak. The Dow futures also off the lows, but still around 150 points in the red. So do keep that entire global picture in mind as well. For our own markets, we are seeing deep cuts come through in the metals pack. So a few of the larger names will be up for you. Take a look at all of those. And also auto has slipped in the past few minutes. So a lot of the top losers on the Nifty today are some of these auto names. We'll talk more about the market action in just a bit. But first up, let's talk about the Bank of Japan, because it shocked global financial markets by increasing the cap on the 10-year yield from 0.25% to 0.5%. Now, Asian equities fell across the board and the yen strengthened after this announcement. Lata joins us now with more on the sudden announcement from the Bank of Japan. Lata.
Well, basically, the Bank of Japan was controlling the 10-year bond yield at 0.25%. Starting today, the yield will be allowed to rise up to 0.5%. We must remember that this has been a very loose monetary policy that the BOJ has been following since 2014. And that policy is changing now, or has been interpreted to change because of higher inflation that Japan is facing. Japan is facing an inflation of 1.99%, which is the highest inflation since 2014. And therefore, this move is being interpreted as tightening. There is risk off in the markets because it is seen as the last major central bank also moving towards hawkishness. It was the most dovish of the banks. Even that one has tilted. And the interpretation on the street is that this is as serious a move as the earlier pivot in 2014, when the Bank of Japan and the government went extremely dovish. This is seen as big a pivot as that. And the expectation is that now they will completely exit from the loose monetary policy. What this basically means is that, you could, while everybody else was tightening, you could still borrow yen cheap for various needs. Now even that resource becomes expensive because the yields have moved, and the market believes that more tightening will come, and that's why you saw the risk off across. Basically, it's telling everyone after the previous week's statements from all major banks, the Fed, BOJ, ECB, Bank of England, Swiss Bank, all of them saying that they mean they intend to be more hawkish. Here's one more coming. It clearly looks like all central banks are going to make money more expensive. That's why you saw this risk off. All risk assets like equities and commodities took a beating. In India itself, you saw the 10-year yield go up, and no one was prepared for this. That was the big thing. A poll done by most of the agencies did not expect anything from the BOJ today at the policy meeting. So it's completely a bolt from the blue. Also because the BOJ Governor Kuroda is to retire, his term ends in April, and the expectation of change in policy was only in April, and that's why the reaction of the markets has been even more sharp.
All right, Lata, thanks a lot for taking us through all of the details coming out of Bank of Japan as well as what the governor had to say. In fact, the press conference by the governor of Bank of Japan was just around an hour ago, and he also said the Japanese market's functionality was hit by volatility abroad and that the trajectory of the economy remained uncertain even into next year, that is into 2023. He also said that the bank estimated inflation to fade by the second half of next year and that the bank in this case would not hesitate to ease rates if it was necessary. In fact, he also expressed confidence that the positives of the policy would ultimately outweigh the side effects. So those are some important comments coming through from the Bank of Japan governor. On the same note, we also spoke to Abhilash Narayan of Standard Chartered Bank and got in his views on the announcement made by Bank of Japan. So let's listen in to what he had to tell us.
Effective tightening of policy came as a surprise to the markets, and that's why we are seeing such sharp market reaction. I think the other reason why we've seen equity markets slide down is because Bank of Japan was the last bank which was still holding on to accommodative policy. So with the shift that we've seen in Bank of Japan's stance just now, what it means is that even the most dovish central bank is looking to effectively tighten policy by allowing bond yields to move higher, and that at the margin has hurt the sentiment for the equity markets. Equity markets could remain under pressure for the next few sessions, given the shift in policy that we have seen. If I look at the implication for, let's say, Japanese yen, we've seen that dollar yen has moved lower by around 2.8%. And what today's move can mean is that we could see dollar yen touch even 130 potentially over the next couple of days. So that could be the big move in currency markets. But yes, it's the timing and the surprise element that is leading to such a sharp market reaction, in our opinion. We are still a bit more cautious on the equities over the next 1 to 3 months, and we've recently gone underweight global equities as well.
All right, that is the view coming in on the Bank of Japan's surprise move. But let's also talk about some individual stocks now. We have Maruti, which is trading under pressure. This after Chairman R.C. Bhargava said that high taxation on automobiles was impeding the growth of the industry. In fact, Parikshit joins us now to tell us more about what he had to say on taxation for this entire industry. Listen in.
So the annual meeting of Maruti Suzuki with the media, there R.C. Bhargav expressed concern about the high rate of taxation. We asked him about his reaction to the clarification on SUVs, the cess and taxation on SUVs, and the possibility of MUVs being taxed at a higher rate as well. R.C. Bhargav said, how can we really expect the industry to grow when the tax rate on SUVs is 50%? He also said that they leave it to the wisdom of policymakers. If the policymakers don't want the auto industry to grow, or they're comfortable with the auto sector growth of 5 to 6% annually, then he won't fiddle with the wisdom of policy making. He also said that we need a rationalization of tax brackets across the automotive sector with a special focus on reducing the regulatory burden on small cars. He says that the auto industry, if it has to grow, then the small car segment must continue to grow. And right now, because of the tax burden, the market is shrinking. When it comes to new launches, Hisashi Takeuchi of Maruti Suzuki said that they will be showcasing 2 new SUVs in the Auto Expo. There will be an electric SUV concept also showcased. We're learning from our sources that one of the SUVs will be a rival of the Thar, the 5-door Jimny that will be launched by Maruti Suzuki later next year. We'll also see a rival of the Sonnet that is also slated for a 2023 launch that will be seen at the Auto Expo from the Maruti Suzuki stable. On FTAs, R.C. Bhargav says that we must drop the protectionism attitude. We must be open to reducing tariffs and get access to global markets for Indian automobile exports.
All right, Parikshit, thanks a lot for getting us all of those comments from the Maruti Suzuki chairman, as well as, what they're planning to do at the Auto Expo later as well. But another stock that we are tracking today is Dabur. This one is under pressure today after a big block deal where promoters are likely to have sold a part of their stake. Vivek is here to fill us in with the details. Vivek?
Well, that's right. So Dabur has been the stock in focus. We told you in the morning before market opening that we are expecting a largish block deal. We told you that we had sourced the term sheet for this particular block deal, and that 2 promoted entities were the ones who are likely to have sold stake. So GAIL Enterprises, owned by Amit Burman, held almost 11.4% stake in the company at the end of September quarter. So he is likely to have paired stake. And the other name is Chaudhary Associates, owned by Mr. Saket Bamban, who held almost 12.3% stake in the company, also is likely to have paired stake. Along expected lines, the block deal happened. Approximately 1% of equity changed hands in the morning at an average price of 571 rupees a share. Further, in a fresh update, sources indicate to our colleague Mangalam that the Dabur promoters are the ones who have sold stakes in line with what we had reported earlier. And the reason for the stake sale that markets were keenly awaiting is that they are looking to fund some private ventures, and the private ventures of the promoter entities included forays into QSR as well as the F&B businesses. Further, sources indicate to him that they are unlikely to pair stake or sell more stake going forward as far as Dabur is concerned. So that alleviates some of the concerns that the street had as far as the promoter stake sale is concerned.
All right, Vivek, thanks a lot for taking us through the details on the block deals on Dabur. The stock around 1.5% lower right now. The other one that we are tracking is GAIL. This after ICICI Securities has put out a report on this stock after meeting with the management. So Sonal is here to fill us in with all of the details. Sonal?
There's an interesting note from ICICI Securities where they say that they met the senior management of GAIL, and the key takeaway was that the reinstatement of gas supplies from Gazprom to GAIL will take some time. Now remember, there is a long-term agreement between Gazprom, that is the Russian entity, and GAIL for supply of gas, and this has been paused since May 2022 and is yet to be reinstated. So of course there's a shortfall, something that we have been highlighting. Now the shortfall in terms of supply to GAIL is around 8 to 9 MMSCMD, and the company has been able to mitigate it by actually cutting supplies to sectors like fertilizer and power. Also, they have reduced utilization of their own petchem plant to less than 40%. They still have some customer obligations that they actually have to fulfill. That is around 1 to 1.5 MMSCMD, and that they have fulfilled via contracts on the spot LNG side. So basically, they have bought gas at a higher price. This also is done in order to ensure that the supplies are maintained. ICICI Securities says that yes, additional volumes from Reliance Industries, ONGC will help going forward, but still in the rest of FY23 and first half of FY24, transmission volumes will be impacted because supply side concerns for GAIL still remain. They also see material upside to transmission tariffs from FY24 because of the regulatory change in terms of pipeline tariffs that we've seen, but that again is from FY24. Gas trading and petrochemicals business will continue to remain under pressure. So the macro headwinds continue to impact the business of GAIL. They have cut their EPS estimates by 10 and 9% for FY23 and FY24, though they have a buy rating with a target price of 127 rupees per share.
All right, Sonal, thanks a lot for getting us all of the highlights of this report on GAIL. But with that, let's get into our first short break on the show. On the other side, SEBI's board will meet later today to discuss a number of issues, including buyback and governance regulations. We will get you more on this after this short break. Hey guys, welcome back. You're still tuned into Business Lunch. Now we're picking up that market regulator SEBI's board meet today will discuss buyback regulations, governance regulations as well for market infrastructure institutions. So Yash is here with all of the details on what we could see at the board meet today. Yash.
Well, that's correct, Pavitra. So of course, it's a very crucial board meeting from market regulator SEBI today, and what makes it crucial is the possible amendments which may come for the buyback regulations in the country. Do remember very recently there was a consultation paper which was floated by market regulator SEBI which suggested various amendments to the current buyback regulations. One big takeaway out of that consultation paper was that the intention to actually phase out tender route buyback to open market buyback and only have tender route buyback starting April 2025. But still there were a lot of suggestions which came for open market buyback as well as tender route buyback. I'll take you through some of the important ones. As far as amendments with respect to open market buyback is concerned, market regulator SEBI had proposed that the maximum limit for such buybacks should be 10% starting April 2023 and 5% from April 2024. Do remember that the current limit right right now is 15% of paid up capital and free cash flows of the company. The time period essentially from the start till the end of the buyback was proposed to be cut to 66 days from April 2023 and 22 days from April 2024. The current limit as far as the time period is concerned is 6 months. Also, one important suggestion was to shift tax incidence fully to shareholders from the company in case of buyback. There were amendments with respect to the open market buyback which also came in terms of eligibility, in terms of which companies can opt for this route, restrictions on volume and price of the companies wanting to opt for such a buyback. Now, as far as tender route is concerned, something which market regulator wants to encourage more, the SEBI had recommended that net debt-free companies can announce up to 2 buybacks in any financial year. The gap between 2 buybacks was reduced to 6 months. This is currently 1 year. Also, what they had said is that the maximum limit of tender route buybacks could be 40% of the paid up capital and free reserves, which currently is 25%. So that's the large chunk of the board meeting today on the buyback regulations. But apart from that, 2 more points. SEBI board will also discuss regulations around disclosure of material events and information, and also finally it will discuss the governance structure for market infrastructure institutions like exchanges and depositories.
All right, Yash, thanks a lot for getting us all of the details on what we could see at the SEBI board meet later today. Of course, we'll get back to you once that meet does conclude for everything that comes out. But with that, let's move on and talk about an electronic systems design and manufacturing company, that is Elin Electronics' 475 crore IPO opened today for subscription. Now, earlier we spoke with Akash Sethia, who's the head of strategy at the company, to discuss their business outlook from here. Let's hear him out.
Just in terms of our EBITDA margins, we've historically always been in a 7.5%, 8% kind of band, which are industry-leading margins. Going forward, we don't expect a material capex to come in. As things stand today, our asset turns are probably closer to 4x on a gross basis. Which, in some sense, the business is at an inflection point where, capex has been done. Because of the backward integrated nature of our operations for the product segments that we operate in, we typically end up being the lowest cost manufacturers because as opposed to a mere assembly player, we end up producing most of the components and the sub-assemblies required in-house ourselves. So therefore, we end up, being one of the lowest cost players. I am unable to give you a specific time, but in general, we expect to do that over the course of the next 2 to 3 years.
All right, that is the word coming in from Elin Electronics. But with that, we have to get into another short break on the show now. On the other side, the European Union nations agree on gas price caps to combat the energy crisis that's playing out in the region. We'll tell you more on that after this short break. Hey guys, welcome back to Business Lunch. The Nifty Bank is also seeing losses widen a little bit now. So we are seeing cuts of over 300 points on the Nifty Bank. But some particular names will come up for you. So Kotak has seen a slip. It is pretty much at the low point of the day. And then you have a bunch of the smaller names, the likes of Dhanlakshmi, Bank of Maharashtra, Central Bank. I'm just naming a few, but the entire lot, UCO, IOB, all seeing cuts widen right now. So that's what's going on with the banking pack. But the other important story that we're tracking is that the European Union, after 2 months of intense negotiations, has finally managed to agree on gas price caps. So Manisha is here to fill us in with more on this, as well as what the impact could be on gas prices. Manisha?
Thank you for that, Pavitra. Well, yes, we've seen the gas prices decline as a knee-jerk reaction or an initial reaction after this European price gap. So when you look at the US natural gas prices, there has been a 15% of a decline in this week itself. And the TTF or the European Union gas prices have declined by 20% in the last 1 week itself. The 27-member European Union has finally decided on a price cap that it gets activated on 5th Feb 2023. And the price cap that they have come out with is at 180 euros per megawatt hours. If you look at the gas prices in the European markets, this year has seen a low of 70 euro. That is how the year started with. We've seen a high or an all-time high of around 350 euros. We are trading at around 180 euros around that at this point in time. And that's exactly where we have seen the cap come in as well. We will see 35 euros over and above is how the review will happen on the prices. prices. As of now, there is what is awaited now is the written consent by all the European members, and that is when it will be treated as approved. What the markets also are seeing is the lower gas availability from Russia. While we have seen Europe inventories above 5-year average, but the markets will look out at what the winter demand really stands at. There are more concerns on the summer natural gas demand going forward there. Most of the banks and brokerages who have put a view out do expect that the natural gas prices for the US, which saw a range of $3.50 to $10 on the higher side, may not look at those kind of highs yet again. So UBS, Bank of America, Citi, Enron, everybody thinks that it is going to be between $5 to $8 per MMBTU of a gas prices that we could be looking at the year ahead, and that's much lower as an average in what we've seen in this year.
All right, Manisha, thanks for getting us all of the details on the gas prices and, the impact that this price cap has had on gas prices. But on that note, we have to wind down on this edition of Business Lunch. The market's really not having their best day, like we've been telling you. It's a 150-point cut on the Nifty. The mid-cap index is absolutely bang in line right now. And the Nifty Bank also seeing losses widen, 0.8% gone on the Nifty Bank as well. Thanks a lot for tuning into Business Lunch. Mid-cap radar on the other side of this short break.